Hey beauties, we are Alicia and Nicole from Positive Image. We are hairstylists, salon owners, and business coaches here to help you navigate the ever-changing landscape of the beauty industry. We are sharing our secrets on creating a salon that thrives. So let's dive in.
Hey, Nicole.
Hi, Alicia.
Today we get to talk about something that people avoid like the plague,
Yes.
but it's very important, and they're only scary if you've continued to avoid them like the plague. Taxes.
Yay. And
Everyone's favorite word.
exactly. And there are some people who do love numbers. I have the privilege of hosting a podcast with one of those people.
Yes, I do. I do love numbers. Oddly enough, I do like the accounting factor. Fun fact. I've only used someone else to file my personal income taxes once when I was 16 and I first got a job and I first went to, what are they called? H&R Block. And then after that, I was like, wait, I can do this myself. And then ever since then, I've always done it myself. And I've almost always, not always, but almost always have had some level of like, um, I guess, small business income as well.
That's fantastic. And not many people can say that they have been able to do that because it does come across as super complex and it is not something that we are ever taught how to do, which, thinking about it, we really should have a taxes 101 in high school. Like it should be, there's so many mandatory courses that we should like understanding credit cards, understanding taxes, all of these things, the life skills, how to do laundry properly, how to wash a dish. But they're not, they're not taught and it's really sad. So we're here to help you to the best of our ability. And just kind of for this topic, we are not experts. We know this stuff based on our own personal use of being salon owners, but we are not officially trained accountants nor lawyers. Do not take this as advice. Do not take this as law. Make sure you do your own research, what you need for your company, for your corporation, and seek out advice from an accountant or a lawyer. But we are happy to help guide you so that you have a broader and better understanding of the Canadian tax system.
Well said. Very important to note. So let's get started with HST because I think that's probably like the first most confusing one, but also kind of the simplest one.
HST is the harmonized sales tax. So this is the tax that you are charging your client on your service or product that has kind of gone out the door. So in Ontario, it's 13%. Different provinces have different percentages. What HST is when you have to remit it to the government. So that 13% is not your money to keep. This goes to the government. This is really, really important. When you get your sales printout from the end of the day and it has everything that you have made, inclusive of HST, you need to take some of that money and set it aside because you have to give it to the government. You are just sort of facilitating the money coming from the consumer to the government. That is one of your responsibilities as a business owner. So as a business owner, because you are collecting HST on behalf of the government, one of the benefits of this is that your business is not charged HST, meaning you might have to pay it when you're buying office supplies or back bar stock and stuff like that. But the money that you are paying to the government, you get to deduct the HST that you have paid on other supplies that you've brought into the shop. Does that make sense?
I'm going to simplify
Okay, please do.
or just kind of repeat for everyone. HST collected on sales from our business is the HST received. That's the plus number that we owe the government. The HST on expenses, so the money we've spent going out, that's the negative number that we can deduct from the money that we've collected. And the end result of those two numbers, expenses deducted from sales, is what we owe to the government. And this is going to change depending, obviously, on what province you're in. I don't even know what goes on in the US. We're strictly Canadian.
Yeah.
in Ontario. So this is how it works here. And so that amount, then you have to file. You have to apply for a number to file. Majority of those that are listening, I'm assuming, not necessarily though, if you're small and just starting out or just starting to think about this stuff, the threshold, I believe, is $30,000 in sales that you should start to charge HST on as a small sole proprietorship. So you have to file for this number. And if you are claiming sales revenue of above 30%, 30,000. It's 30,000. Are you fact checking there?
Mhm.
It's either 30 or 35.
No, it's 30.
30, perfect.
In a single calendar
Year?
in a single calendar quarter.
Quarter. Oh.
Yeah.
Oh, really? I always
Yeah,
thought it was the year.
no, according to this, it says you're required to register and start charging HST immediately if your total taxable revenue exceeds 30,000 in a single calendar quarter. You must
Okay.
be charging HST. Your total taxable revenue exceeds 30,000 over previous 4 consecutive calendar quarters, you must start charging. Interesting. Okay.
Okay. I mean, so that's nice. It's a little bit higher than I would have expected because that means 120,000 per year
Mhm.
of this is revenue, not HST that would have been collected. Those are two very different numbers. So something to keep in mind is when, especially in that first quarter, if you're like, I might actually start to be over this, you should have already filed for HST, but you're going to need to set up this account and make that filing. You can, side bonus, you can backdate once you register your account, which is a nice bonus because if you just opened and you have a lot of expenses, then you can collect. Might be the one and only time you actually receive the refund versus owing the government the HST. But so then you're going to start making filings either monthly, quarterly, or annually, depending on how much you make and in how good standing your filing is in. The government will start to send you letters after a certain amount of time to let you know that you are in good standing, or maybe they're going to call you and tell you you're not. That's when they get scary. Otherwise, beforehand, they're super lovely, super helpful. When you start to owe money, it's less. They're a little more like, pay us now. Um, this also, other side fact, I'm sure there's probably conflicting information online, but you can't bankruptcy out of this money. You, no matter what, owe this money. So don't get any wild ideas.
So meaning if you're, let's say, $100,000 in debt and you claim bankruptcy to wipe your $100,000 in debt clean, but within that $100,000, you still owe the government $30,000, you still are liable to pay that $30,000, even though you've tried to wipe it clean.
You got it.
Okay, that makes sense.
Those types of funds are protected.
Okay, which makes sense because it is money that you have collected on behalf of the government. And there are a lot of pros and cons to owning or to having an HST number. And some of them, and I think the biggest ones is when you are starting out a small business. And I know we've touched upon this in our summer series too, but when you're starting out a small business and you have an HST number, any of the equipment and things that you are doing to build out your shop, you can apply against your HST. So even though you don't have income coming in, you can claim back the HST from that. And from a growth mindset, if a client's coming in and they are used to paying your $100 for a haircut, and then all of a sudden you apply for HST, well, now that $100 haircut becomes $113. So why not just start charging it from the beginning? Because it makes you look like a legitimate business rather than somebody who's just $100, no tax. So it kind of gives you this legitimacy right from the get-go.
Yeah, that's a good way of putting it. And just it creates a less awkward conversation. And of course, your clients are going to be excited that now you're doing well enough that you are charging tax. At the same time, they don't understand that, just the same as most of you listening today don't understand it. No offense. I don't mean that in offense at all whatsoever. It's just most people hear taxes and they're like, no, la, 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 I'm not listening. It's just the fact of the matter. We avoid it as much as possible.
And I think when we were kind of planning for this, you also, Alicia, you said that you had a tip on kind of what to set aside or like how to calculate what you potentially are paying in the future.
So for me, as a rule of thumb, I like to set aside 10%. So our HST amount is 13%, and I've found on average, it varies, but a 10% is a good safety spot so that I still have a little bit left over just in case. We collect 13 and then we pay out, but obviously I'm not purchasing the same amount that we have in sales because that's not the point. We want profit. We want our expenses lower than our sales. So generally, if I put aside 10%, then I just have extra for some other things as well. Do you do anything like that?
I don't, but I've been fortunate to have a balance that I can pay my monthly without issue or without problem. And I think one of the amazing books that if anybody does need a good book to kind of help you with taxes and stuff like that is called Profit First. And there is one that is specific to salon owners, and they talk about having different bank accounts. And this would be a circumstance where having a bank account just to put that 10% away would make a benefit if you are somebody who sees money in that account and is happy to spend it. So having something like I think I would put 11% away and then have that 1% buffer. So every month I would take a look at what my sales were and then take that 11%, put it into the HST bank account, and that way I know I just have that buffer going. And the HST, when it is due monthly, it's due by the 31st or the 30th or whatever the last day of the month is. If it's quarterly, it is if your term is from January to March, then the HSD is due at the end of the month in April. And then it's every quarter, and then yearly, I think you have until March 31st. So you have 3 months if it's yearly in order to pay your
Okay.
HST. Yeah.
That makes sense. I just want to make note that you can file either with your accountant or through NetFile online. And it's pretty simple. It doesn't take much, and usually you can pay directly there or through your bank.
Yeah.
Cool.
Perfect.
Payroll.
Payroll. This one's always an interesting one because there's not a simple calculation. It's not like HST where you can say, okay, it's going to be 10% of my earnings or whatever. You really need to have either a payroll person to help you out or a program to help you out with payroll. Having a spreadsheet going on just an online calculator is not going to help you. You'll probably end up paying more in the end, and there'll be a mistake or two. So we're very much encouraging you to have a professional do this side for you. So to remit your payroll, there are different frequencies and different due dates. So according to CRA, what you want to look at is your average monthly withholding amount from 2 calendar years prior. And so you can remit quarterly. And so this is for employers with the average monthly withholding amount of less than $3,000 who maintain perfect compliance records. So you cannot be late. This is due by the 15th day of the month of the following quarter, similar to HST in that way. Then you have your regular, which is your monthly. And this is for employers who have an average monthly withholding amount of $25,000 or less, and those who are not eligible for the quarterly remittance. And this is due on the 15th day. So if October was your pay period, then your remittance is due November 15th. You can pay this through the bank. You can pay this through your bookkeeper or payroll company. I'm not sure if there's a net file for this or not. I know I just pay it through the bank and I do the file and pay at the same time. So I would encourage the listener to kind of look into this.
I had a friend that used to remit through something similar to Netfile.
But it changed.
So I don't know if it's still available, but yeah, if it's changed, then that's, yeah. They change things all the time.
They
don't
do.
tell us anything. Go on, sorry.
And there are two other like accelerated payments too, but that's when your average monthly withholding amount gets over 25,000 and over 100,000. So we're looking at big corporations, and usually if you're that big, you have somebody doing your payroll, and this is not the podcast for you. Well, maybe it is, but not this portion of it.
Welcome for everyone.
Exactly.
I do have a bit of a rule of thumb when I am counting out my payroll or like budgeting for hours or even like budgeting like what if I can afford to take on a new hire. I like to add about 12% on top of what their hourly rates are or projected commissions would be. It is not perfect, but I feel like 12% gives me a close-ish number.
I tell you, folks, she is the numbers person. So if Alicia has a hack for something like this, my rule of thumb is to trust her rule of thumb.
I'm into that.
And then lastly, what is a remittance? Like, we're throwing out these words, but what is a remittance? So when we pay our employees, what we're doing is we're paying them the hourly wage or your salary or your commission or whatever the amount is. And then what either the person that you've given all of this information to or your payroll company or the account that you're using, they do the calculations for you to figure out what the income tax that your employee has to pay on this payslip, what the CPP is, so that's the Canadian Pension Plan. The employee has to pay CPP from the income that they have earned, and the employer has to match that portion. So if on, say, $1,000, that you're paying $50 CPP out of their pay, then as an employer, you also have to pay that $50. I'm just using round numbers. They are not accurate. Just letting you guys know. And then we also have to pay EI. So it's very similar to the CPP where the employee takes some of the money from their salary, and that goes to the government for the EI. And then the employer's portion is 1.4% of the salary. So the employer also has to pay EI at 1.4%. So all of these numbers get calculated together, and then that becomes your remittance for all of the employees, whether it's quarterly, monthly. This is why you need a payroll company or bookkeeper or something to help you with this, because it can be quite complex with all these numbers.
Some kind of system. And I would also add that these numbers are different per province, and they're also different every year. Every year they get changed. Sometimes they stay the same, but usually they get changed. So knowing what the percentage is key with having a software that you do it yourself, a company that does it for you, or an accountant that does it. They're going to know these numbers because that's going to be the bigger factor. And then the employee percentage and the employer percentage isn't always the same. Sometimes it's the same, sometimes one's higher than the other. So it just gets really complicated. So using some form of a system or guideline is definitely helpful and key. And then the biggest one, income tax. Many of us will start out as sole proprietors. Some of us will start out as corporations. What's the difference between the two, Nicole?
Okay, so a sole proprietor is you. You own the business. All of the business income gets taxed as if you are just earning all of that money. And a corporate or a corporation becomes its own entity. So, yes, you are the owner of, but the taxes that the business pays is separate from the taxes you pay as essentially an employee or an individual.
Again, we're not accountants. I am not an accountant, but I was told the rule of thumb is that if your profit at the end of the year, so if you've been paying yourself as a sole proprietor, whatever amount you've been paying yourself as your shareholder amount, loan to owner amount, whatever you want to call it, whatever money you've just been taking out to pay your own bills, um, including what's left in the company is between $50,000 to $70,000 at the end of the year, then you should transition to a corporation, and that it'll make more sense when it comes to the percent at which you are taxed for that end rate, as well as several other benefits.
Yes,
Nicole, I feel like you got a few benefits
I
you
do. I
really
do.
like.
Well, it's one of the benefits that really kind of helped me was actually around the same time that I changed from sole proprietor to corporation. I decided to get a new car, and my corporation is a numbered company operating as my hair salon name. And when I was able to apply to get a loan for the car, the finance department was telling me that because I owned my own company, that I might not be eligible for a loan. And so when I told them that it was actually a numbered company, he said, "Oh, well, let's put it through. Like if you can provide T4s, which I could, if you could provide pay statements, which I could, then we'll see if they'll approve it. And if they do, great. And if they don't, then we'll look at some other avenues." And so because I had all the documentation and because I was getting a T4, I got approved and it was great. And it was super, super easy. This kind of similar things for different kind of bigger purchases. Also, having that T4, having that pay statement has been a huge benefit. Being a corporation, it doesn't it doesn't protect you, but it basically it helps put you at a bit more arm's length from the business, where the business becomes its own entity. So if you think about I like to think about like my business as my twin. Like it's we're still in the same family, but it is its own thing where I can make decisions as okay, Nicole is making this decision. No, no, the business is making this decision. And that kind of helps my brain offset. And even when I'm talking to my employees, it really helps. Like I'm an employee of this entity of this business. I'm also the owner, but I am still an employee too.
That all makes sense. I think those are all like key things to include. And yeah, I mean, at the end of the day, it's all a matter of where that money sits and how much goes back to the government and looking into what the best situation is for you personally. I think I was going to add when it comes to like the topic of being a sole proprietorship versus a corporation and then payroll when it comes to you as the owner. At no time are you submitting EI for yourself.
Correct.
Um, the government might yell at you a little bit in a newsletter, in a letter, a paper letter to you, that you're not supposed to do that. Um, so keep that in mind, as no whether you're a sole prop or a corporation or a partnership, you still have to, if you want EI benefits, you still have to create, I don't know if it would be called a claim, but you have to create an installment commitment and create installments to that fund. Otherwise, you don't have EI. It's not a part of what you get, whether you're a corporation or not. And then CPP is also something you can elect out of. Some accountants will tell you that it makes more sense to create a dividend. I have no idea about these things. I've tried to look them up and I kind of understand, but I don't fully understand. Anyways, we'll suggest that you invest through your business in dividends with your CPP amount. Don't get rid of your CPP amount, but to do it that way instead, and then that might actually make more sense. Those are just like a whole nother topic of better investments
I think we need to
things.
get an accountant on the show and we can ask them all the questions and the
All the
viewers can
things.
send us questions about this because it is a gray area in our expertise. And I think again, we'll reiterate, do your own research, talk to your own professionals. We are not giving tax advice. We are just giving an understanding of how the tax system works.
Yes. And then the other thing is, so hopefully your business is profitable. You can also make income tax installments throughout the year. And it may also be recommended by the government as well. So that way, at the end of the year, you're not left with this massive lump sum that you need to pay, because that one is a difficult one to have a set aside for. You could, I suppose, put a percent every month or every week. Sorry, excuse me. But you just don't know at the end of the day how much revenue you're going to have compared to your expenses. You can have a budget, you can have a projected budget for how much you think that'll be, but it can still be hard to nail that down. As well, the several different categories that you get taxed at is also a gray area and confusing, because there's federal tax, there's provincial tax, and then it's going to be, again, different, like we were saying initially, from if you're a sole proprietor versus a corporation. A partnership is also, as far as I know, viewed more like a corporation than a sole proprietorship, because you have to create a single entity because there's two people.
Hmm.
But that's, again, I've never had a partnership, so I don't have intimate knowledge of this. This is just what I am to believe.
There are disadvantages and advantages to both, but again, finding a person to talk to that you can look at your own unique situation and figure out which advantages versus disadvantages work best for you. The corporate taxes, income taxes, they are filed once a year. Generally, if you're sole prop, it's the years from January to the end of December. If you're a corporation, it is whatever you have decided that you want that year to be. I weirdly went with May to April, which is interesting. Handy because it's offset to what the tax year is. So my accountant's not as busy when my things roll up because they've just finished doing everybody else's HST and now I'm the month after. So I find it helps in that regard. But it's whatever you decided to do when you set up the corporation that you chose your year end.
And lastly, if you are a sole proprietorship, you don't actually have to file your taxes, your income taxes, by the normal, what is it, April 30th date. You have until June 15th, I believe. It changes because your income type is different versus you getting T4s.
So we went over basically all of the Canadian, specifically Ontario tax system, HST, payroll, your corporate tax or your income tax as a business, whatever entity you chose, and just kind of getting a really in-depth look at like the different ways to pay, what it is, and how often you need to pay the government. And if you don't pay the government, they will find you and they will hunt you down. So just do your taxes. It's not scary. Just find a really, really good professional to help you out and just trust in their genius. They know what they're doing.
Thanks so much for listening in today. The Positive Image podcast exists to empower hairstylists and salon owners with real conversations, practical tools, and authentic stories, building confidence, connection, and community in the beauty industry. Subscribe to stay tuned in for our next episode.